Welcome, everyone, to episode 1 of Robinland's very first podcast. So today we do feature our very own Robinland CEO, Scarlett Chen, and alongside her we have Jack from InfoToken and Graham from Polyex. So in this episode, we do discuss blockchain as an industry, but more specifically, we're going to take a deep dive into security tokens. So this event was held live on Twitter Spaces, and if you want to catch future episodes live, be sure to follow us on Twitter at RobinlandIO. Now, please sit back and enjoy the show.
So, thanks everyone for joining today. Really appreciate the time. And I'm Scarlett. I'm, CEO of Robinland. And we're having Graham today from Polymesh Network and also Jack from InfoToken DAO to talk together on the use of blockchain as a technology and also the space on security tokens specifically. So in terms of my background, I was a PhD in econ at Stanford studying housing and real estate. And, I specifically was looking at financial innovations in housing and how that solves problems, of the duality between ownership and consumption, in a sense that there will be people who is trying to just own a home, but have to face a large lump sum. And at the same time, speculators to them, housing is just not a great asset to invest in because of the large size. So if you can find a financial instrument that pegs the house price, but doesn't give you the underlying asset, then it decouples these two, and both speculators and homeowners have a better time. So that's what I was writing about. And after graduation, I went into Google as a data scientist, where I came across their internal crypto group and realized that crypto is essentially the kind of quote unquote financial instrument I was looking for. So essentially, tokenizing a piece of real estate is something that decouples duality between ownership and consumption. And I dig deeper and realize the other way around is also very interesting, which is trying to bring in real asset into DeFi as a way to sort of stabilize the treasury or a collateral pool of DeFi lenders such as Maker. So that's sort of where the idea of Robinland came from. And then I was lucky enough to, run into a team that were all interested in that. And then we started working on this together. So that's a sort of very long intro of, where I came from, how the idea of Robinland came about. And I'll hand over to Graham to talk about himself.
Sure, thanks. So, hey everybody, I'm Graham Moore. I'm the head of tokenization at Polymesh. Polymesh is a blockchain built for regulated assets. So a bit about my background. So after I got out of school, I was really excited about getting into finance. So I did my CSC and CPH, which is sort of the Canadian Series 7 equivalent. And then I did my CFA level 1, and then I started working at an investment advisory firm. And I was very, very bored. So I left my job at the end of 2014, and I was actually planning to go into kind of health and wellness. I've always been a pretty obsessed person with all things kind of physical health and working out and fitness. And I played semi-pro hockey when I was in university. But then pretty much my first week out of my finance job, I found out about Bitcoin. And when I say find out about Bitcoin, I mean what most people think of when it's kind of the second or third or 10th time you hear about Bitcoin, when it's no longer this kind of stupid thing that makes no sense that kind of nerds are using, or maybe it's a scam, or it's just a pump and dump scheme or something like that. But I realized it was an actual technology, so became completely obsessed. Couldn't really think about anything else. I absolutely fell down the Bitcoin rabbit hole. Started talking to every single person I could. Started going to other investment advisory shops and talking to investment advisors, saying, "Hey, you got to get your clients to buy this stuff." Everyone looked at me like I was an idiot. This was kind of early 2015. They all kind of changed their mind in December 2017 when they finally bought. Of course, at the top at $20,000. But that's a story for another day. And then just kind of being in the Bitcoin and crypto space in Toronto back in those days, I met up with the two founders of Polymath. So this was kind of mid 2017. I said, "Hey, what's Polymath? It sounds like it's really exciting." And I realized it was really right at the intersection of what I found very exciting, which was the regulated finance world that I was already a part of, but then mixed with crypto and how you can use this new technology for all different kinds of things. So I joined Polymath as the first employee back in September 2017, and I have sort of been there ever since. And so recently, this was in February, I made the transition from Polymath to Polymesh. So you can think of Polymath as the for-profit commercial corporation that looks to earn revenue, building products on top of Polymesh. So Polymesh is the base layer infrastructure. the blockchain. And Polymath builds lots of tools on top so that folks can use the blockchain easily. And other things about me, I guess I can touch on. So I also wrote the first ever ABC book about Bitcoin. It's called B is for Bitcoin. If anybody has a 2-year-old or 3-year-old who's learning their ABCs, go check that out. It's on Amazon. And then I'm also on the advisory board of a company called Red Swan. So also in this intersection of real estate and blockchain. So Red Swan tokenizes real estate properties and makes them available for investors to invest in.
Great, thanks so much. That's a really nice intro. Jack, if you're still around, maybe you can also introduce yourself and see whether you want to try emceeing again if the internet connection is better now.
Yeah, let's see. Can you all hear me okay? Am I coming through at all?
Sort of.
Sort of. Okay, I'll give it a few minutes. Or better yet, I'll someone stop me if I'm getting too choppy to speak.
Yeah, I'd say it's too choppy. I don't want to make that call, but that's my vote.
All right, I will. I'll rely on you then. Okay, be back in a few minutes.
All right. Given that, we can start, talking about our topics today. So I think for today, there are 3 parts. First is about just in general blockchain, the technology, and second part on security tokens, and then the international aspect of, the environment of blockchain. So on the first, so this is, I believe what Jack has talked about before with, all of us. So blockchain and cryptocurrency have, in the public imagination, continued to be associated primarily with currency development, speculation, and more recently, art and collectibles. However, there are several ongoing technological and business developments that promise to bring new applications well suited to be decentralized, censor-proof, publicly available nature of blockchain ledgers. So that's the overall, sort of background. So I think the interesting thing is, what Jack has mentioned here is blockchain has, sort of historically been, something when you mention it, people associate with speculation or, just currency in general. But now, in the most recent few years, it has shifted to become, quote unquote, a technology that solves problems. So here are a few questions that we can talk about. What are some of the industry examples that we can use to better understand this kind of application? For example, real estate inheritance, demolition disputes, real estate certification, and things like that. And number 2 is how have the technological and legal infrastructure matured in the last 5 years? And lastly, what are some of the misconceptions of, quote unquote, putting X on blockchain that should be dispelled? So on that, Graham, what do you think? What are some of the thoughts you have?
Yeah, I've definitely got many thoughts to kind of tackle that first question. So what are some of the industry examples? I think real estate has proven to be a very interesting and very pertinent at this point in time use case for blockchain. So I mentioned I'm on the advisory board of a company called Red Swan. I'll kind of walk through how they view the space, and then I'd love for you to kind of touch on how Robinland's viewing it. And I'm sure there's some overlap, but definitely some differences as well. And so kind of how Red Swan's looking at this is using blockchain to enable efficient, automated, and transparent creation of financial securities, and then management of financial securities and settlement of financial securities. And so their specific vertical is real estate. And so one interesting thing and how they view the market. So the CEO and founder there is a guy named Ed Nowakity, who's a broker with Cushman & Wakefield for I think about 15 years in Houston, Texas. And one thing he kept noticing was for asset owners. So let's say they have $100 million building. There's kind of 2 ways that they can go about pulling cash out of the building. The first way is finding a gigantic real estate fund to give them $20 million or to buy the whole building outright. And so those are kind of the Blackstones of the world and the Starwoods, et cetera. And so they're going to press that asset owner on valuation. They're going to press them on covenants. They're going to talk about, who's mowing the lawn and how often and what kind of light bulbs are you using for the fixtures, and can we use these different kinds of light bulbs, and all that kind of stuff. And That's seriously what happens in these negotiations. And they'll last for 6 months, maybe even longer, maybe even a year, or maybe even years if the asset is, call it billions of dollars. And so the asset owner, that's one option they have to pull some cash out of their property. How can they get cash today? The other option is they go to a bank, and the bank loans them money at an interest rate that's generally not that great. It's better than if they didn't have the asset, of course, but it's not ideal, and it still takes time out of their day and figuring out their operations and can they support this level of debt on their books, and there's a huge amount of questions, and that still takes a certain amount of time, and again they're going to get squeezed on valuation. And so now there's this third option, where what if I took the $20 million out of my $100 million building, and instead of offering it to one entity like Blackstone, or offering it to, or taking out debt on it to this one entity of a bank, what if I chopped it up into 1 million pieces, and then I got 1 million investors to invest a little bit of money in each of these pieces? And so that's effectively what Red Swan's doing, and that's what is pretty exciting to me about the kind of commercial real estate intersection of blockchain, and where they're also using polymass technology to do that, is where now you can have this kind of global pool of potential investors that want to invest a little bit of money into real estate. So they want to invest $100 or $1,000 or $10,000. They don't have to invest the entire $20 million in one check and be one entity to do that. So now we can have investors from all over the world looking at real estate properties, and they're not going to make sure the real estate owner is using the right light bulbs, and what kind of lawnmower are you using, and which janitorial services staff are you using. They really just want to speculate on real estate. And so now they have the ability to do that, whereas previously they had no way to do that whatsoever, unless they were in a country like the United States or Canada, where they have access to real estate investment trusts, for example, which have really high fees and which aren't super targeted in terms of the real estate that they can invest in. So I love using this example. If I want to get exposure to New York real estate, so I'm in New York right now. I want exposure to New York real estate. I can invest in a REIT, and they're going to have a building on First Ave. They'll have a building on Third Ave. They'll have some buildings around Midtown. There will be one in Brooklyn. Maybe 3 of them are in Brooklyn. One might even be in New Jersey. Not super targeted. But now with tokenization, what's going to happen over the next kind of 5 to 10 years is I'm going to be able to invest, and I can make a specific investment thesis and then act on it. So I can say I want to invest only in buildings that face Central Park. I only want to invest into the units that face Central Park interior, so that they're not looking anywhere else. And I only want to invest in the units that are above the 7th floor. So you can't do that today. But what's going to happen is every single unit of every single building in the entire world is going to be tokenized like this, and I can get hyper targeted and hyper specific in the types of investments that I want to make. So that's kind of the biggest and most important industry example that I have for that, and I'd be excited to hear kind of more about how Robinland is doing it. And I'm sure the listeners want to hear about that as well.
Yeah, that's actually very comprehensive. Really interesting to learn about Red Swan. There's definitely lots of similarities. So for Robinland, what we're doing with blockchain technology is twofold. One is to use it as a way to bring real assets into DeFi to stabilize the treasury or collateral pools of DeFi lenders such as Maker. So for those of you who don't know, Maker is like a central bank in DeFi that's minting out their own currency, which is DAI, and they're supporting it or backing it with treasury or collateral that used to be major, mostly crypto native, so ETH or BTC and things like that. So it's all good, and except for the fact that crypto is just highly volatile. So you have one day with like 50% upside and another day with 50% downside. So what do you do with it when you're trying to create a stable coin? You need to over collateralize. So for example, now there are about $6 billion worth of DAI in circulation, but Maker is backing it with $12 billion worth of collateral, which is a almost 200% collateralization rate. And that is worse than the traditional banking sector, not better. And that's a problem if DeFi really wants to catch on and become mainstream. It needs to do better in terms of capital utilization. So there are definitely multiple ways to solve that. But one very obvious thought is, what about bridging in real assets? Because real assets intrinsically are just less volatile. And on the other hand, their volatility is also orthogonal to that of crypto. So in finance, there's a sentence saying, there's no free lunch except for diversification. So if you can mix your collateral pool with, a bit of crypto native asset and some real real assets, that's sort of essentially the best of both worlds. So that's what we are trying to help Maker or other DeFi lenders to achieve, which is they can sit in their comfort zone, just dealing with us, smart contract based, while we deal with the real estate lenders or borrowers, pen and paper, old fashioned way. And we have all the magic happen within. So after we onboard real assets into our, say, special purpose vehicle SPV, we can go through a completely legal process to issue tokens on chain that represent the underlying asset called security token offering, or STO. And this way, we have just turned real asset into on-chain crypto native assets in a legal fashion. And now these tokens can be pledged with Maker to access their financing. So this way, Maker now have some added real assets into their pool. On the other hand, the real asset borrowers can access liquidity from DeFi in a very cheap and fast way without having to directly deal with smart contract, because we are taking all of that heavy lifting from within. So that's, to me, a very interesting use case of blockchain technology, because now it has built a canal between two worlds that used to be completely segregated, which is real asset returns and DeFi liquidity. So that's one side of things that we do, which is on the 2B side. And on the 2C side, what I see us as is creating a new type of asset called crypto bond. So in DeFi or in crypto, traditionally, there are either hyper volatile but super high return, altcoin or meme coins or NFTs, or stable coins that are essentially the currency. But there isn't a lot of things in between, which is passive income, steady return products. You can of course park your stablecoin in Aave or Compound, but then those returns are supported by other crypto. So if the market is down, everything is down, including your return on Aave. So what if we can provide a kind of return that's crypto native, that's bridged in from the real asset side, which is real estate? That will provide essentially a bear market proof type of passive income, steady return asset to diversify people's portfolio. So that's the kind of things that Robinland on the 2C side or the retail investor side is trying to create. And the process is actually fundamentally similar, bringing in fundamentally very high quality commercial real estate debt with steady interest return, and then turning that into on-chain crypto tokens by legally tokenizing them through STO, and then selling those to retail investors. So this is, to me, something that's very interesting, because now crypto investors, without having to on-ramp and off-ramp their stablecoin to fiat and vice versa, can access steady return that's bridging from the real world, but in a very DeFi native way. So that's what Robinland has been doing or is trying to do, using blockchain technology to solve problems in the real world.
Hey, can you all hear me now?
Yeah, much better.
Yep.
All right, fantastic. All right, thank you for really dropping a lot of interesting perspectives. I think they're ones that complement my own very well. So for some background, for those of you who didn't earlier, my name is Jack. I am an anonymous DeFi enthusiast. Somebody who has been in the space for I would say upwards of 4 or 5 years, since 2017. I came there after a career in we'll broadly say finance and management consulting, by way of prediction markets, and found in crypto a very fun place to speculate. And in 2017, that was largely what it was used for. I think the beginnings of the security tokens were there, but it was a period when I think, as a lot of people here know, when I think the anticipation of a potential economic value really kind of was far higher than the the actual capacity of the industry to deliver it. It wasn't until more recently, around DeFi summer, that I started to dig a little bit more into the potential broader social use, societal use of blockchain and how it can interact with the economy. My own particular slant on it is from the view of a member of a DAO. For those of you who don't know, it's a decentralized autonomous organization, or broadly speaking, an inclusive means of membership and ownership that's facilitated by blockchain use. I see it as a potential means of of a new organization, of a new structure of organizations and economic actors, and that's something that I participate now in the capacity of a member of an information token DAO, which is something of a professional services firm equivalent in the DeFi space. Now, what I think is interesting and complementary to your perspective is really taking on the DeFi view. Scarlett mentioned that the one of the potential uses of real world assets is for an orthogonal return stream, one that is uncorrelated with DeFi and crypto native sources of returns. Another potential means of it, and I think is a potential means of really activating the liquidity available on chain, is the ability for the outside world to act as a demand source for stable coins and other forms of capital on chain. I think it's one thing that's I think underappreciated is the need for demand for this stuff to exist from somewhere other than crypto apes such as myself. Having people anywhere in the world as real world economic agents being able to tap things like MakerDAO or individual lenders to access capital and more interesting, more flexible funding sources, allows the chain to sustain the sorts of interest rates that continue to attract further investment and in a second order way drive further development. What that in turn does, I think, is facilitate even more of this sort of development of infrastructure that can further connect some more industries that otherwise would need a little bit more time to dig in. So that's all to say that I'm massively bullish on the ability of blockchain to act as a home and an infrastructure for a lot of economic activity that isn't currently seen. But that's something that is very much in that's very much in flux, and I think there's a challenge to convince people that this is in fact happening. So I'd like to follow these views up with is a question that was mentioned before, which is what has changed in the space that allows more of this economic activity to exist on chain. I mean, what makes today a good moment, or at least a better moment than the times when you had like DentaCoin being launched on in 2018?
Are you implying DentaCoin isn't good?
I'm still waiting for it to happen.
Yeah. So I mean, a lot of stuff has changed, and I think it's just sort of the natural life cycle of any new technology adoption, where kind of right when things happen, there's a lot of money sloshing around in the space, and everyone's trying to figure out how they can get their hands on all of it. And so, people launch a coin for dentists that doesn't really make any sense whatsoever. And people think the technology is stupid, and then the banks dismiss it, or in this case, banks in whatever technology cycle, the legacy incumbents dismiss it as being stupid and some toy for kids. And then what starts to happen is people start building actual things. And so, MakerDAO is obviously one of them that we've been talking about, USDC, USDT, Red Swan, Robinland, Polymesh, all these companies start building actual things that provide real world benefit. And so I think it's just something that happens. And the main thing for me has been really seeing the change in the last 6 months to a year, where we've started talking to banks and they are all very, very excited about this technology. Whereas 2017, 2018, we were calling them and they were saying, okay, yeah, maybe we'll see what might happen in the future. We're going to keep an eye on it. We'll pretend to do some innovation theater type stuff, and at least our board will be happy, and we can pretend like we're following along with the technology trends. And I think one of the really big things that happened was SockGen with Forge, and so them doing a pretty similar thing to Robinland, actually, where SockGen, they created a debt instrument on chain, and then they actually applied for that to be used as collateral in MakerDAO. And so one of the largest banks in the world saying, hey, we're going to play around with this stuff and see what happens, that starts to get the attention of every single other bank of similar size, and even the larger banks, because they're saying, okay, well, somehow this got through their compliance team. Somehow they figured out how to do this. They had lawyers on staff, and they obviously examined this for maybe a year to figure out how to do this. So now we need to figure out how to do this. And I think that's where we are in the stage right now, where one bank and now a couple other banks are playing in the space as well in similar ways, that are actually really exciting and hopefully going to come up pretty soon. And so now all the banks have to say, okay, well, I have to keep up with my competitor. And so that's been a really big catalyst that I've seen in the last sort of year or so.
Yeah, that really is great. So one thing I wanted to mention is we do have our own Robinland Twitter account, which is what I'm using now. And in there's a link tree, and using that, you can go into our Discord and Telegram, where you can drop in questions. So if you have any question that you want to ask the speakers, you can drop it, there, and we'll make sure that we cover them later in this, event. So that's just one announcement I want to make. And later on, we'll also open up the space for everyone to talk. And on the topic, I think is really interesting because the practitioners and the regulators are two parties that are trying to figure out an equilibrium for a certain type of activity to happen. So if you look at sort of regulations with blockchain, 20 years ago, ICO isn't really a thing, and regulators wouldn't even know how to think about this, right? So it's always sort of practitioners driving action from regulators to say, hey, we're already doing this, so tell us what can and cannot be done. At least please define things so that we know what are allowed and what is not. And that is something that's really interesting, because one might think the less regulation there is, the better it is. But I actually disagree, because it's only when things are properly defined, then we can start talking about what kind of activities are allowed in what way, to whom, and things like that, which actually help the space to mature. So the law on security token offering is such an example. So a long time ago, it's, when people mention tokens, there isn't a clear definition of what is a security and what is not. And now the SEC has finally wrapped their mind around that and has, quote unquote, published guidelines on saying, utility token should be something that facilitates transactions or govern a DAO and so on and so forth, essentially serve a certain function, but should not generate expected return. On the other hand, security token is something that's explicitly defined as a security. So the form of it is a token, either ERC20 or ERC1400, whatever you have. But underneath, it has to follow the rules the SEC have put together on how to issue securities in the US. So this is something I found super interesting, which is security token is really a combination of two things: the technology piece, which is the token piece, and a legal piece, which is the quote unquote security piece. And this is a perfect example of how regulators is sort of working together or working around the constraints with the practitioners to find a way for certain activities to happen. And now security token is still kind of small, but I think it's already a very good example of how, blockchain or crypto activity in the future could look like. There will be, and hopefully, there will be guidelines on how to conduct each and different aspects of activities in different jurisdictions. And I believe, Jack will be talking about both of these topics in later parts, so I wouldn't spoil the audience too much. But that's, one very interesting aspect I wanted to mention.
Yeah, I actually think that represents a pretty fantastic segue to our next section here, which really is a discussion on the state of security tokens. I mean, as you mentioned, Scarlett, it's I think it really is an interesting feat of technology and in kind of legal crafting and regulatory crafting that that's allowing practitioners to add a little bit of structure to what was I think historically kind of a space for wildcatters. I think there's there is, and I think correctly, a, a, a sort of development, a frenetic development that happens outside the bounds of regulatory constraints, which I think allows for the sort of experimentation to get ahead of a potential shaping, so that when it comes time for the regulators to show up, there's already a sort of a set of community standards that can be advocated for by the crypto natives. Now, so I'd like to take a little bit of a step back here, and dive a little bit more, and get ready to dive a little bit more into this, as it is the primary focus of our discussion. So security tokens, what are they? Why are they here? And what really allows them to be a key piece of this future development of blockchain that we've I think, like, we all agree we really want to see.
I'll jump in there first, if that's okay. So security tokens, what are they? They're financial securities that live on a blockchain instead of living in a private database or on a napkin or in a lawyer's filing cabinet somewhere. Why are they here? I think they're the obvious next evolution of blockchain technology. So we kind of hypothesized this back in 2017, where all these people started creating all these tokens, and some of them were money, some of them were these governance things that allow you to decide what happens with the protocol, some were to earn these staking rewards. And we said, okay, well, I mean, what's the largest market in the whole entire world? Well, it's financial securities. There's trillions of dollars of securities. If you add derivatives into that, there's potentially quadrillions of dollars of securities in the world. And so what better way to make blockchain a bigger thing than to have the largest market in the whole entire world built on top of them? And so tokens work really well at being able to send from anyone to anyone, anywhere, anytime. And that's great. And that's kind of how Bitcoin has decided to work. And that's wonderful. And I love a neutral base layer protocol for money. Securities do not work like that in the majority of the world. You have to know who your investors are. You have to know where they live. You have to potentially know what kind of assets they have. If you have to follow accredited investor rules, all of those kinds of things are how securities work in the real world, and in most of the countries that exist, where there's kinds of these trillions of dollars worth of securities. So back in the day, Polymath, we looked at that and we said, okay, well, we need to build some type of infrastructure for this compliance criteria. How can we make sure that only party A can transact with party B if they've been verified? And so those are the things that we started building. And really, it's so that we can have quadrillions of dollars worth of assets on blockchain. We are of the belief that every single financial security in the world will exist on a blockchain at some point in time. I cannot tell you when. Is that 2 years from now? Is it 5 years, 10 years, 20 years? I'm not sure. But we need to build all the necessary compliance infrastructure for that to work. You were talking about, wildcatters first. That's what the pioneers come in to do. Is they experiment with the technology. They're willing to kind of play in the gray area. They're willing to bend some of the rules. They're willing to be those first people who get sued by a regulatory body or get taken to court, because they want to push the space forward. They see the exciting opportunities that are available when a new technology gets created. BlackRock is not going to do that. That's a factual statement. They are not going to be the first to do anything. State Street is not going to be the first to do anything. BNY Mellon is not going to be the first to do anything. But they will be maybe third, fifth, 10th, something like that, and they're going to perfect it. And it's similar, like Apple, doesn't generally create the most brand new thing, but then they perfect it after someone else tries it and they see that there's a use case there. Very similar idea where these gigantic companies with their gigantic boards, where all their board members are billionaires and they have billions of dollars of capital, and they have a million different shareholders all around the world. They just can't really be the first to jump in the space, and they need that regulatory certainty. And so that regulatory certainty is coming, and we've been talking about that on this call, where that is coming in a big way, and it's enabling these legacy players who have the trillions of dollars to play with and the trillions of dollars worth of assets, it's enabling them to start using this technology in a meaningful way.
That's great. And I'd like to actually quickly follow up on this. We speak about security tokens as being an inevitable thing that is going to be adopted and universalized. I'd like to know what sort of advantage does listing these things on chain confer on on providers, on firms? Like why do they want to go on chain? What's the advantage there?
Yeah, so we chalk it up to three big things: efficiency, automation, and transparency. So it's way more efficient to trade these things on chain. It's way more efficient to create them on chain. And you can automate a lot of the, especially compliance functionality that you couldn't automate before. One really cool thing that is eventually going to happen, it's not built yet today, but for something like a convertible debt instrument, where if I choose to exercise, I should automatically get if I choose to exercise my debt instrument that I have that can convert into equity, I should be able to automatically receive that equity instrument from the debt instrument into my wallet or my custody or with a third-party custodian that I'm using, and should be effectively free, and it should happen instantaneously. That's really not how it works today. There's a ton of lawyers that need to sign things. There's a ton of people that are going to overlook it. And so really similar to what Robinland's doing, where you can now just have this kind of piece of real estate that exists sort of in the ether almost, ether. But on the blockchain, right? And so you have this piece of real estate that exists, and then I don't have to talk to anybody to use it as collateral. In the same way where, back in the day, if I wanted to send a letter to someone, I'd need to go to a post office. I need to talk to a human being and get a stamp and put it on this piece of paper and then put it in this slot, and then I could send my communication message to someone. Then I would use a phone, and I still have to talk to the phone company and say, hey, phone company, can I use this phone to make this phone call? And so same thing's happening in finance right now, where in the past, anytime I wanted to take money out, I would have to go talk to a human being in a bank branch. And I would say, hi, could I have some of my money, please? Then they got bank machines, but again, still sort of like talking to a human being. I have to leave my house. I have to go press some buttons somewhere in a different physical location. Now I can engage in global capital markets. I can even be an investment banker sitting on my laptop now. With security tokens, that's what it allows me to be. When you look at things like SET protocol, for example, I can be an investment banker. I can create a structured product sitting at home, and I can sell it to 8 billion people. That's fundamentally absolutely insane. If you told someone 50 years ago anyone is going to be an investment banker in the year 2020 or 2022, they would look at you like you were crazy. You have to go to school, you have to get the right designation, you have to go get the right licenses, all this kind of stuff. But now anyone can do anything in capital markets effectively. I'm not suggesting that you do. Of course, talk to your lawyer, et cetera, et cetera. But I think that's the really cool thing that we're seeing here is the efficiency and the automation of a lot of the compliance facets of this is enabling anyone to be kind of any piece of the puzzle in global capital markets. And then the other thing that's really cool is the transparency. So there's a lot of question marks that arise, especially in private securities offerings, where who owns what and what happens in X scenario, where the transparency allows everyone to agree on the state of the world. So that's really what Bitcoin enabled as its creation is. You cannot disagree that one ABC 257 owns this amount of Bitcoin. Every single human being in the whole entire world is able to agree that account owns that amount of Bitcoin. And now every single person in the whole entire world can agree how many shares are owned by one person or by one corporation, where it's not that simple when you start to get into even the public securities market, but especially the private securities market, where, again, there's pieces of paper sitting in lawyers' filing cabinets. Some of them haven't been signed. One person signed it in the wrong spot. One person dated it wrong. One of the CEOs made a deal with someone else, but they didn't actually have board approval to do that. So this one investor thinks they have these shares. That doesn't exist on blockchains. Everyone can see every single account that exists and the amount of tokens that they have, which represents their ownership interest. And then even the transparency in public markets isn't even good either. I love talking about Seed & Co. If anybody wants to go look this up, Seed & Co. So Seed & Co. actually kind of owns all of the stocks on an exchange when you trade them publicly in America. And so this was happening when the New York Stock Exchange was trying to scale. At one point, as they realized it was too hard to send all these messages back and forth between all of the brokers and update all of the cap tables of all the companies at one time. So they just decided, okay, well, let's just make Seed & Co. this company that owns every single stock, and then we don't really have to update the ledgers for anything. Like that's the actual scaling method that's used to scale public securities markets, and it's still used today, which makes absolutely no sense in the world of blockchains. So the lack of transparency is something that decreases the amount of trust in the securities market. So if I want to trust someone that I actually have the 50 shares that I hope I own, I kind of have to take their word for it. I can maybe get a lawyer to file an injunction or something like that and go get some documents to be shown. But increasing transparency makes everything better in a world of increased trust, because now I'm more likely to do more deals with more people. So I'm more likely to fund a project if I know that I have trust in what I actually own is something that I own. So those are kind of the big three: efficiency, automation, transparency. But excited to hear if anybody else has some other thoughts.
Yeah, it's really interesting. One thing that immediately came up to my mind is, so when Jack was asking, so why does it have to be on chain? What benefits does it add? Then immediately I was thinking of essentially what we're saying about the bridge between DeFi liquidity and real asset return. So there is $2 trillion worth of crypto in terms of market cap sitting there, and it's now disconnected with the US M2, which is another $20 trillion. And it will be really powerful if one can build a canal between these two, essentially allowing DeFi's liquidity to flow into real asset without leaving DeFi. And we can do that with security token. It's almost sort of built for that purpose, because security token is a technology that now allows real asset to be turned into pieces of crypto tokens that legally represent the underlying fractions of real assets. But then the crypto native investors, either institution or retail, now can invest in these cryptos, and that action actually allows them to access the return profile of these underlying assets, which are, as we've sort of mentioned before, orthogonal to that of crypto. And that is something only possible because now there are on-chain versions of securities, which didn't exist before, say like 3-5 years before. So this is an activity that's unlocked by this legal innovation, and it's only at the very beginning. Now, if you look at security token, 80% of that is real estate. So for some reason, like it or not, real estate has been the asset class that's most advanced in bringing itself on chain. Most likely because it's very stable, and this is something that complements crypto native asset really well. But in the future, I can imagine, say, for example, hedge funds being on chain, which Arca is already doing, or shares in startups being on chain, or other types of private borrowing and lending, commercial papers, corporate bonds, all sorts of different real assets being able to be bridged into DeFi, allowing institutional lenders to park their money, or retail investors to do the same. Because in crypto, you might imagine most people are chasing after, say, the 10,000x return tokens, but those are assets with returns very short-lived. So it might be 300% for a few days, a few months, but not sustainable. And also there are bear markets, which we are experiencing this year. So when that happens, people will be pulling out from positions that are used to be very lucrative. And what do you do with all the stable coins that you have on your hand? You probably wouldn't immediately sell all of those into fiat and then buy a house somewhere, but you'll be trying to find ways to park your cash, quote unquote, park your stable coin in DeFi or in crypto. And in the past, it's only Aave or Compound, which are crypto native, but now you have other choices, which are returns from real estate or from hedge funds or from commercial papers, and so on and so forth, which just immediately expanded type of risk return profile that crypto tokens used to have. And this is all allowed by security tokens, which is a combination of a legal and technology innovation. And that's also what allowed Robinland to be here, right? Being the bridge between the two worlds, and really cashing in on this piece of innovation on the legal side.
Yeah, I mean, one thing I'll chime in on this point is that as a member of a DAO that does several types of investments, we have so far not encountered any projects with a security token. And now, what we'll typically do is come across projects that either offer equity investments or ones that offer just straight up tokens, and then there are obviously various combinations of the two that can be pursued. What this does effectively is introduce a lot of uncertainty, and a lot of I think like a lot of really ultimately kind of like Baroque ownership structures, or otherwise other types of arrangements when you're dealing with a class of investors some of whom are anonymous, some of whom are in different legal jurisdictions, and it becomes a very it can effectively lock people out of certain types of investments. And so, to me, I think what's especially exciting about the promise of security tokens is really, it comes back to what we've all, I think, kind of hammered on, which is just kind of allowing some sort of structure to facilitate the kinds of economic activities that we've all been wanting to do since day one. Now, we're obviously still part of the way there. I mean, I think adoption is growing quickly on the demand side. There are more projects. Love to hear more about that. I would also love to hear more about the sorts of challenges and moves to offset moves to overcome them with regard to public opinion and adoption of security tokens.
Yeah, in terms of kind of the headwinds and stuff. So at Polymath, we started building our own blockchain called Polymesh back in 2019. And it was a clear result of us speaking to the largest institutions in the world and asking them, hey, do you guys like security tokens? What don't you like about them? Will you use this technology? What needs to happen? And we kept hearing the same things over and over again. We kept hearing there's 5 main things that they didn't like and that needed to be fixed for them to use the technology. So one was governance, one was identity, one was confidentiality, one was compliance, and finally settlement. And so I'll go into those really quickly just to elaborate on what I'm talking about. So governance, especially as it relates to forks, was a huge concern for a lot of banks and a lot of custodians. So let's say I have a security token. I own $1 billion worth of this security token, and it's on Ethereum, and it's pre-ETH Classic fork. What happens after the fork? Do I tell all my shareholders, hey, don't trade for 6 months? We're going to see which fork becomes the victor. How do we decide which fork becomes the victor? Is it based on hash power? Is it based on what Vitalik says? We have no idea how to deal with that. And so there's been a lot of interesting research papers out of firms like Deloitte and KPMG talking about forks and governance is an absolute nightmare when you start to get into the world of real securities, where again, BlackRock is not going to use a security token that is on a blockchain where there can be forks like that. It's just an absolute governance nightmare. So on Polymesh, we deal with that by having a forkless architecture. So there's always one canonical version of the chain that is sort of the ultimate source of truth. The next one is identity, and so again, talking about kind of the regulated asset space, it's very scary to a lot of institutions to deal with people and institutions that they don't know. And so again, one thing on Ethereum that we kept hearing, and other general purpose blockchains, don't want to bash on Ethereum here. It's just kind of the architecture of how general purpose blockchains work, where they're trying to be everything to everyone. They're built with anonymity in mind. They're not really built for financial securities from the get-go. And so for identity, you talk to somebody like a very large bank. You talk to JP Morgan and you say, hey, okay, you're going to make a trade of this $50 million security, and you're going to pay $20 in gas fees. And they go, okay, cool. Where are the gas fees going? And you say, I don't know. They can't really engage in that system. They can't engage with that architecture. They could be sending the $20 in gas fees to a miner who's in North Korea. Just a really big problem for them. And there are sort of some ways to get around that. But it's not very elegant, and it's not ideal. So on Polymesh, we tried to solve that by having all of the miners, not all the miners, all the node operators. So it's proof of stake blockchain. All the node operators have to be regulated financial entities. So now when JP Morgan uses a security token on something like Polymesh, they know that at least that transaction fee that they're paying is going to someone who has some type of financial license. So that gives them a lot more comfort. Then on top of that, Polymesh requires a KYC process to onboard to the chain. So again, fundamentally different from everything like Bitcoin, Ethereum, et cetera. So built for regulated assets. For compliance, we started building all this tech on Ethereum back in the day, and we started reaching the Ethereum gas limits in terms of what you can do with smart contracts. So, when you want to restrict party A from transacting with party B, you want to institute a 24-hour volume limit. You want to institute a 7-day volume transfer limit. All these types of requirements and tech is built as second layer smart contracts, and it becomes really computationally expensive to do that. And it just makes something as simple as updating your whitelist, for example, which is who can and who can't hold the token, being $10, $20, $100 in peak gas prices. So computationally expensive in terms of how you can do compliance. So for Polymesh, a lot of that compliance is baked into the base layer of the chain itself. We haven't built Polymesh to do things like create a ton of different governance protocols, et cetera, whatnot. It's built only for regulated financial assets. That's the idea. So we can really optimize what lives inside the chain and what logic that the base layer of the chain understands itself. On top of that, so I mentioned confidentiality. So that's a huge focus of us. So we actually have a patent pending process called MERCAT, which deals with how can you obfuscate a lot of the transactions for financial assets so that parties don't necessarily know which wallet belongs to which entity, which you can essentially figure out over time. If you're on a completely public open source blockchain, where you can start to see, okay, we know JP Morgan owns $20 million worth of this asset, and here's this wallet with $20 million worth of the asset. It's probably JP Morgan at that point. And JP Morgan's going to broadcast that they want to offload $10 million of those tokens at some point. They're going to get front run, and they're going to lose out on a bunch of opportunity. And then also just the privacy issues are really big for them as well. So having a confidentiality solution is really important for these banks, especially when they're dealing with millions and billions of dollars. And then finally, settlement is a huge one. And this is best illustrated by an example. So for example, when Visa said that they bought a CryptoPunk, I sent them a Poly token. Visa couldn't say, no, I don't want to hold on to this Poly token. So now Visa has Poly on their balance sheet. They had to talk to their accountants and figure out how to deal with that. Do they have to claim it as income? Should they keep holding it? Do they sell it? How do they sell it? How do they know where this thing came from? Is this entity an entity that we're able to do business with? And a million other people started sending them all these other NFTs. Some of them were, NFTs of penises and whatnot. Now Visa has a penis NFT on its balance sheet. They don't want to deal with that, but they have to, because that's how the architecture of a blockchain without any type of settlement infrastructure works, like Ethereum, where every single transfer must be accepted by everyone. So by contrast, on Polymesh, we said, okay, well, banks don't want to deal with this. They cannot just have any single transfer be automatically accepted. And so how settlement works in the traditional financial world is sender affirms settlement instructions and receiver affirms settlement instructions. And only after both parties affirm settlement instructions can a trade occur. So that's something very important on Polymesh. And there's a whole bunch of other literature that you can look at if you want to get into our settlement engine, how you can do multi-leg settlements, and how atomic swaps work and whatnot. But that's kind of the easiest example to show, right? Is the existing infrastructure, in our opinion, doesn't work as well for financial institutions as it could on something like Polymesh. And so we think this more purpose-built infrastructure is something that's going to help shepherd the space along, especially for these really large institutions who have the trillions of dollars.
Yeah, that's really fascinating, and you can imagine. I mean, how these sorts of questions really start to balloon up when the organizations in question are not just large, but also have an international footprint. One thing I'd really be kind of curious on closing this discussion with would be by expanding the scope somewhat to the international context, and and asking like how crypto, how security tokens, how do this kind of envision development play out on the international stage, and what sorts of headwinds exist there as well.
I think this is really interesting because coming from China and living in the US, I kind of see how regulatory environments shape crypto activities very significantly. So at some point in the past in China, there were 70% of mining power. But nowadays, it's completely outlawed, and there are still some protocols operating, but it's all turning to underground. And because of that, there are a lot of people who are shifting their activity out from China to, say, Southeast Asia or the US. But then for the US, in the most recent few years, there are continually new regulations coming out specifying what kind of activities can and cannot be done, also regulating or limiting certain activities. But there's also innovations. For example, there's a state in the U.S. that now essentially recognizes DAO as a quote-unquote legal entity, which is something that's very exciting. And what I've been seeing is, despite that, there's a lot of shifting of activities out from quote-unquote the two major countries into other places that are more crypto-friendly. For example, now you can easily set up a whole legal structure in BVI plus Cayman, plus some place in Southeast Asia, such as Malaysia, to totally do token issuance packed with real assets completely legally in the local jurisdiction. Issuing utility tokens even. But this is something that's unimaginable, say, in US or China. And for example, most recently, Korea became one of the few Asian countries that are extremely crypto friendly. So I imagine there will be a lot of new crypto startups linking real asset to on-chain crypto tokens in Korea. And in fact, there's already an enterprise called Casa that is doing it, and they just got whitelisted one of the exchanges in Singapore, essentially issuing security tokens or security tokens on chain representing pieces of real estate in Korea. So I think the international aspect is very interesting, and by looking at how regulators from different places respond, you can almost guess what places must be center for crypto activity going forward 3-5 years down the road, and then you can react accordingly. And it used to be the case that US or China are leader in creating new protocols where other people follow, but things are also changing, such as us seeing Axie Infinity coming out from Southeast Asia, setting the ground for the type of play to earn kind of games. So Robinland is also sort of observing that trend, and potentially could have some type of legal entity set up, out sort of offshore. We don't know yet, but we're definitely very sort of observant of this kind of international aspect of trend.
Yeah, I'll add on that. So, I mean, we've seen a lot of interest outside of the United States, whereas call it 2017, 2018, a lot of that was inside the US, but now a lot of it's coming outside. And the reason being is just more friendly regulatory jurisdictions where folks are allowed to experiment with this technology, and they don't have to be afraid of the SEC. And so one interesting thing and one use case that people are using our tech for is just by effectively, blacklisting people that are in the US and saying, okay, so we can have these global pools of liquidity that exist, and folks from all of these different countries all around the world can trade with each other on this blockchain thing. And we'll just prevent people from the US from trading with these other people, and they can kind of rest easy knowing that they have control over the tokens and who can and who cannot have access, and they can deal with any of the regulators that they want. And if someday a regulator, let's just pick one, the French regulator says, hey, we don't like this technology, or hey, give us access to all of your books or something, or ask for something that's egregious or overstepping their bounds as a regulator in a foreign country, they can just sit with a click of a button. They can say, okay, sorry, no, French people can't touch this security anymore. Bye. Right. And so we've seen that's what's happening a lot with even just crypto in general, where certain exchanges have to blacklist people from certain countries. Binance has to open Binance.us instead of Binance. Binance opens up in Ontario, which is where I was born and raised in Toronto. And then the Ontario regulator says, no, Binance, you can't do that. And so Binance just says, okay, cool, Ontarians can't use this service anymore. And so maybe they'll have to open up Binance.Canada or something like that, But ultimately, all this regulation is coming, and it has been coming for a long time. And we've sort of seen this occurring as kind of an inevitability. And you can only sort of pretend that you're in some other jurisdiction for so long with a VPN before a certain regulator gets wise to that and starts to understand that. But yeah, we've seen a huge interest in both Africa and Asia recently, where what's happening with security tokens is there's a lot of high quality assets in the United States that investors want exposure to, but they can't get exposure to. They can't open an account with TD Ameritrade because they live in the wrong country. But there can be an entity who tokenizes that asset in the United States, for example, and then gives investors in Nigeria, Vietnam, et cetera, access to that investment. So that's a really cool development we've seen recently.
I mean, that does, yeah. So it seems like there's plenty that's encouraging. There's plenty of challenges, and it makes me think that there's there's going to be work, but we're in a really good spot. We're coming up kind of close to time, and so I'd like to ask the both of you if there's any special news, alpha, sort of guidance for people listening that relates to this topic that we haven't covered yet, or with either of your own projects.
Yeah, I'll go first, I guess. Yeah, so I would highly recommend following me on Twitter, of course. I would say that I'm pretty biased, but I do think I drop a good amount of alpha in there. And then also going and checking out Polymesh on Twitter. So that's at Polymesh Network. And then Polymath as well. So Polymath Network. So kind of two different spins on things. Remember, Polymath is the for-profit company that's building tools on top of Polymesh, and Polymesh is the underlying blockchain itself. So a lot of good information in there. One thing you can do in the next 2 days is participate in our NCAA March Madness bracket challenge. So you can win 10 million Polyex if you get a perfect bracket, which is obviously pretty hard to do. But first place is still 10,000 Polyex, which is a pretty good prize. And then on top of that, we recently announced last week we have a $50 million $50 million Polyex developer grant program. So if someone wants to build something like an exchange on top of Polymesh, you want to build an automated market maker, or you want to build a wallet on top of Polymesh, there's a ton of different ideas that we have, and those are all available. If you go to our Twitter, you can find out where they are, but they're also in our GitHub. We've got a pretty well laid out grant program there, which we've already received a ton of submissions for. So we're really excited to start paying developers to build some cool stuff on Polymesh.
Yeah, so I'll share that, Robinland is going to launch its 2C product in June. So that means at that time, you can come to our website and purchase tokens that legally represent pieces of real estate using either crypto or fiat, and also will allow you to be able to get the steady return to diversify your crypto portfolio. And it will be commercial real estate debt in Long Island City, which is one of the most prime areas in New York. And will be essentially mostly luxury condo construction, luxury apartment constructions. So that's something that at least I found really exciting, because right now I'm actually in Long Island City, sitting in one of those buildings myself. And we'll have a lot more coming up on our social media and also our website going forward. So please follow us on Twitter to get the news. So it's at Robinland.io, which is also the account that I am on right now. So it should be pretty easy for you to follow. We're also going to have a bunch of events coming up on topics that people find interesting, on investment, on real estate or crypto in general. So that's something that I wanted to share.
That all sounds great, and all very exciting news. I will certainly be entering my own bracket, which will probably be terrible.
Let's go.
Let's go, colleges. Yeah, I mean, I think that's pretty much most of the things I was interested in covering. Certainly, if there's time, we can entertain some questions from the audience. I don't know who's monitoring the Discord, but there may be some stuff there as well. Okay, I think if there isn't anything, if there is anything direct right there, I think there's so we've mentioned that there's a there's certain Twitter sites pages that you can go to. There's there's plenty of research that you can do. I personally encourage anyone to try to get as involved in this as possible. There are many different ways to do so, but certainly engaging in the discourse is one way to do it. I'm told that there is a question that was asked in the Discord. So are there any plans to wrap Polymesh assets to be used inside MakerDAO or other ETH protocols?
Ask Robinland.
Yeah, so I should clarify that.
Yeah.
So Polymesh or Polymath is an infrastructure technology provider that allows people like Robinland to onboard raw assets into DeFi really easily. So it's like us using Polymash to enter into Maker. So that's sort of the relationship between us. But you're definitely right. There is plan. So we're going through the process with Maker, trying to be one of their asset originator, bringing on first lien secured senior loan projects in Long Island City into Maker's collateral pool, and accessing their financing to bring very cheap and very fast lending to the real estate developers to release, the housing crisis in the U.S. There just isn't enough houses in the U.S. for people to live in, and if DeFi liquidity can be of any help, I think that will be a huge benefit to the entire housing sector, either in terms of investment or financing. So that's the process that we're in. We passed the community greenlight poll earlier this year in January, but we're still in this very long process of onboarding. And hopefully at some point this year, we'll be able to actually access Maker's liquidity pool to complete this project. So, that hopefully is answers the question.
Yeah, no, I'll just touch on it a bit. In terms of kind of Polymesh specific and wrapping Polymesh assets, we probably wouldn't be the entity specifically that would wrap those assets, and we're also not the entity who would create assets. We provide the infrastructure so that folks can create assets and manage those assets and eventually trade those assets on chain on something that works for institutions like Polymesh. But yeah, that's actually something that we hear quite a bit of. Is if let's say MakerDAO doesn't go cross chain and they don't have the ability to use collateral on an asset on Polymesh, for example, or Luna or on Tezos or wherever. How does that happen? It'll probably be with a wrapped asset. The issue when you wrap an asset like that is you start to lose the compliance criteria that you wanted in the first place when you issued it. And so that becomes kind of a difficult legal question. So I think what's probably more likely to happen is these stablecoin creators and like MakerDAO, like Terra Luna, like Tether, etc. And then ones that haven't even been invented yet, they'll probably be cross-chain compatible at the end of the day. If there are assets that they want access to, and most of these stablecoins want access to the largest universe of assets possible, they'll probably start integrating other chains. But that's a pretty good. It's a really good question. It's something that we think about a lot. Is how can you get all these different chains to interact together while still maintaining the compliance criteria that you want? And so that's one of the interesting ones. And of course, you could create an asset on Polymesh, then you could wrap it and you could issue it as an ERC 1400 on Ethereum. You can still have that some semblance of that whitelisting, and only certain addresses can hold the tokens and other ones can't. But yeah, lots of question marks, lots of exciting things to think about building. And we don't think that we will probably be the ones that are building that. We think it'll probably be other folks. So, if you have a developer idea and you want a grant to build something like that, come talk to us.
Yeah, you heard the man. Go join and go help in the building effort. So I think I think that we can call that a wrap. This is this is really fun for me. I learned a lot from the both of you. Hope this was similarly revealing to all the listeners here. Yeah, thanks again, Graham and Scarlett, for taking some time and sharing your thoughts, and really excited to see how you all work together in the future.
Thanks, Jack.
Thanks so much.
Thanks, Scarlett.
Thanks, William. Thanks, Jack. Thanks, everyone, for coming. Really fun talking together. Learned a lot. Hope to see you again in future events.